And Friday was an oddly flat day for a big news day. MBS were up 27 basis points early this morning. Stocks were actually winning at the same time, being up 19 points. The bond market got most of the 0.2 of additional implied inflation from today's PCE numbers in the form of a 0.1 beat in March numbers and a 0.1 revision in February's. But month-over-month numbers came in right in line with an unchanged forecast. Combine that with an ECI number that was only 0.1% higher than forecast, and bonds were able to breathe a sigh of relief relative to what may have feared yesterday's PCE prices inside the GDP data. Implied slightly higher numbers today. So the core PCE came in month over month up 0.3% on a 0.3 forecast, but it is still going up. It was 0.3 previously. Core PCE inflation year over year came in at 4.6% on a 4.5% forecast. It was 4.7% previously. Last month was revised up 0.1%. Employment cost index came in at 1.2 versus 1.1 forecast, and it was 1.0 previously. So this is all adding up to more inflation. So we're probably going to get at least one more Fed rate hike. The Chicago PMI came in at 48.6 versus a 43.5 forecast, so the economy is still holding strong. Bonds improved overnight on a combination of friendly central bank news in Japan and softer economic data in Europe. From there, bond traders were relieved that PCE prices weren't any higher than they were, considering the warning embedded in yesterday's GDP data. Chicago PMI tried briefly to push towards higher rates, but buyers quickly regained control. At the end of the day, we are up 25 basis points. Stocks were up 34 points. The 10-year was down 9 basis points. So at the end of the day, we were at 100.77, which puts us in a super narrow range here between the light blue 200-day moving average, the bright red Fibonacci level, and then right down the middle of that, we have the 25-day average. So all of our trending indicators are kind of converging on each other in a very narrow range here. Banks are currently experiencing rising deposit costs. If the costs can't be fully passed to borrowers, profits will fall, reducing lending. It's estimated that a 10% reduction in profits reduces lending by regional and smaller banks by 2%. And based on prior rate hike cycles, a 2% lending reduction is possible. It's likely to lead to a painful reduction in GDP growth of as much as 0.4%. So looking at next week, it's going to be a big week. On Monday, we're going to get some ISM manufacturing PMI, which people are going to look at to try to get a predictor on what comes on Wednesday. Tuesday is factory orders as well as ADP jobs, but then we get the FOMC rate decisions. We're going to hear from them on what they're going to do. All things are indicating mostly towards a 0.25 raise again. But the big thing is looking at the verbiage to see what's going to come after that. Then on Friday, we're going to get non-farm payrolls and unemployment rate and stuff like that. So have a great weekend, relax, and check out some of our sponsors at, thatmakesense.com, as well as the others listed here. Have a great weekend, everybody.